Okay, let's dive into something that's really been making waves on Wall Street. You remember supermicrocomputer SMCI? Not that long ago, it was just the absolute belle of the AI hardware ball. I mean, its stock soared, went from about $100 to over $1,000 in under 18 months. Just a dizzying climb. But here's the thing. The surprising whisper now is, well, it could be on a glide path all the way back down, maybe to just $100. So in this deep dive, we're going to unpack a really detailed analysis. It's from Making Sense, and it's titled Supermicrocomputer, Path to $100. Our mission really is to explore how this mix of factors, hype cycles, margin pressures, supply chain risks, even what the insiders are doing, how that might all be conspiring to reprice this Silicon Valley Cinderella, turn it back into a pumpkin, so to speak. And just to be clear, this isn't some kind of takedown piece. It's more of a reality check on a company that really seems caught in a perfect storm. So let's set the scene for you a bit. Remember, for most of its life, SMCI was kind of sleepy, right? A niche maker of high-performance server boards. Pretty obscure for most people. Exactly, not a household name. But then, 2023, early 2024, AI just exploded. And AI needs hardware. Lots of it.
A huge amount. GPUs especially.
Right. Those high-performance GPUs, like NVIDIA's H100s, they needed special homes, dense server builds for data centers, stuff that could handle trillions of calculations.
Yeah.
And SMCI.
Yeah.
They stepped up. They delivered. Their agility, working so closely with NVIDIA, getting custom builds out fast.
Yeah.
It made them an instant darling.
It really did.
And investors just piled in, pushed that stock, like we said, $100 to over $1,000 in, less than 18 months. It felt a bit like 1999 again, didn't it?
It absolutely did. And that Making Sense report, it nails it with a line. When the music stops, chairs vanish fast.
Oh, yeah.
That's the immediate caution, how quickly that euphoria can just evaporate.
Okay, so if that's the setup, what happens when the AI hype train maybe not stops, but starts to slow down a bit?
Yeah.
The source we're looking at points out, look, the AI boom is real, no question. But how companies like SMCI actually monetize it, it's a bit murky. That huge spending binge on infrastructure that fueled SMCI's earnings, it couldn't last forever. It was always going to taper off. Why was that kind of inevitable?
Well, the analysis highlights something pretty critical. The big cloud providers, your Amazons, Googles, Microsofts, they essentially front-loaded their GPU buys.
Oh, okay.
By mid-2024, they basically stocked up, got enough H100s, enough custom server racks, enough to last them a while. They built out that foundational AI layer very, very quickly.
So the direct consequence for SMCI was?
Their backlog, which, it looked like a sold-out Taylor Swift tour. It started to thin out pretty significantly.
And how does the market react when that kind of deceleration happens, especially to a stock that's been on such a wild ride?
Yeah, that's where the market can be pretty unforgiving. Once that growth slows, even just modestly, these high multiple stocks, they get repriced, sometimes brutally.
Right.
SMCI's PE ratio, the price to earnings multiple, it was hovering near triple digits back in early 2024. That's usually reserved for hypergrowth software, right? Not hardware.
Definitely not hardware, usually.
So the source says it's now starting to reflect a reality where growth looks, a lot more mortal. And that's a tough adjustment for a stock that flew so incredibly high.
Okay, let's pivot a bit. Let's talk about something that maybe gets overlooked in all the excitement. Margins. Crucial for hardware companies.
Absolutely correct.
SMCI operates with, pretty tight margins, doesn't it? Gross margins, 15, 20% maybe. And net margins can be razor thin.
Yeah, very different from someone like NVIDIA with their 70% plus gross margin.
Exactly. Now, SMCI's advantage was speed, customization, being more affordable, undercutting Dell or HPE. But that strategy doesn't leave much cushion, does it?
Not much at all. And that thin margin, it becomes a real vulnerability when you hit the kinds of pressures SMCI is seeing now.
Like what specifically?
The report mentions rising shipping costs, more expensive labor, GPU lead time stretching out, even while overall demand for these specific high-end servers is cooling a bit.
So connect that to the bigger picture. What does that mean for their actual earnings power going forward?
It's a really critical point. The margins that made the boom profitable, they're now evaporating, or at least under some serious pressure.
Right.
And without strong margin expansion, SMCI's earnings power is basically capped. They can't just grow revenue to fix a margin problem quite like a software company could. It's a hardware game. The economics are just different.
And then there's this other risk, one that's definitely not going away. Geopolitical tensions.
Yeah, that's a big one.
SMCI is a U.S. company, sure, but like most hardware firms, heavily reliant on Asia. particularly Taiwan, for a huge chunk of production.
That's right.
The source highlights this escalating risk. The U.S.-China tech Cold War, Taiwan as a potential flashpoint. What's the impact been, and how immediate is this threat, really?
Well, the source is clear. This isn't some maybe someday problem. It's happening right now.
Yeah.
The Biden administration's export controls, they've already created headaches for SMCI's biggest customers, limiting what can be sold where.
Right.
And there's potential for more restrictions, data center hardware, AI chips, tech partnerships. SMCI could easily get caught right in the middle. Investors are, I think, finally waking up to that geopolitical drag that's kind of baked into every unit SMCI ships now. It complicates everything.
Okay, so beyond these external things, the making sense analysis looks at something else. What the insiders, the people closest to the company, have been doing with their own stock.
Yeah, that's often telling.
What do they know that maybe, you, the retail investor, don't?
Well, the report points to pretty relentless insider selling. Over the past 6 months or so, CEO, CFO, head of sales, directors, they've been actively selling shares.
And not just like trimming a bit for taxes?
No, the report emphasizes it looks like significant dumping, not just diversification. And that's usually a pretty solid sign that, well, the best part of the ride might be over.
And the big players notice this.
Oh, absolutely. Institutional investors track these Form 4 filings religiously. When they see insiders bailing like that, the smart money starts asking, has the growth story peaked? And that can really reverse momentum.
So let's talk numbers then. Valuation. SMCI's current revenue run rate, maybe looking out to mid-2025, it's around $14–15 billion.
Roughly, yeah, based on projections.
Okay, so let's run a really optimistic scenario. Let's say, heroically, they hit a 10% net margin, which is tough for this kind of business.
Very tough.
That gives you maybe $1.4, $1.5 billion in net income. Now, slap a generous multiple on that, say 15x, which is still pretty high for commoditized hardware.
Quite generous.
That gets you a fair value around, what, $21, $22 billion. But here's the kicker, or the disconnect. As of Q2 2025, SMCI's market cap is still way up there, north of $35 billion. So what's needed to even justify that number?
Yeah, it's a stark gap. I mean, to justify that current price, SMCI would need to keep growing like crazy, 30–40% annually, and expand margins significantly, all while somehow dodging supply chain issues, geopolitical shocks, GPU gluts. It's like walking a tightrope over a minefield.
Wow.
Based on the report's math, yeah, fair value seems much closer to that $100, $120 range per share. It's sobering compared to those $1,000 highs.
Okay, so SMCI had that early mover advantage in AI racks. Huge. They carved out a niche.
No doubt about it.
But guess what? The competition. They weren't asleep forever. The big guys, Dell, Lenovo, HPE, they've all woken up.
And they have advantages SMCI doesn't.
Exactly. Deep pockets, huge scale, decades of experience managing global supply chains.
Right.
So as demand softens maybe a little, how are these giants hitting SMCI?
They're leaning in hard, offering aggressive pricing, bundling services, locking in those big cloud customers with multi-year deals. The report suggests that SMCI's moat, its competitive advantage, it was real, but maybe not that deep. And now that the tide's going out a bit, you start to see how exposed they are to competition on price and scale.
And we can't pretend this is all just pure fundamentals, right?
Yeah.
SMCI's massive run-up. It had serious, let's call them meme stock vibes.
Oh, definitely.
You saw YouTubers, Reddit threads, TikTok, people calling it the next NVIDIA. It wasn't just a sober re-rating based on financials. It felt like a mania at times.
Low float, hot momentum, options market going wild.
Exactly. But now the story's shifted. Institutions seem to have largely rotated out. But retail investors, the report suggests they're still holding on, kind of praying for a second wave.
Right, but this raises a crucial point. Second waves don't really happen in hardware unless maybe you're Apple and SMCI is just not Apple.
Yeah, good point.
This isn't some broad consumer trend. It was really a CapEx bubble tied to one very specific intense phase of AI build-out. Retail can prop things up for a bit, sure, but the report warns when fear really sets in, when losses start piling up, those exits get crowded fast.
Okay, so let's look squarely at this $100 case. Is it probable? Not just, possible, but actually probable.
The source lays out what seems like a pretty reasonable bear case scenario.
Okay, walk us through it.
Imagine revenue growth slows down. Not collapses, but slows to maybe 10% a year.
Okay.
Net margins compress even more, say down to 6%. Free cash flow shrinks. And the market assigns a more realistic multiple for a hardware business, maybe 12 times earnings.
Right. So what does that math look like?
Well, under that scenario, you're looking at maybe $900 million in earnings. Apply that 12x multiple. Fair value for the whole company is near $10-11 billion.
Okay. And with about 55 million shares, that puts the per share value where?
Around $180 per share, Matt.
Right. But 180 isn't $100. How does it potentially fall that much further?
Well, you factor in maybe a broader market correction, right? Or just strong risk-off sentiment hitting tech stocks, and then you get that wave of retail capitulation we talked about, panic selling.
Yep.
That $180 could pretty easily become $140 and $120, and suddenly $100 doesn't look so far-fetched. Momentum cuts both ways, hard.
And what's interesting here, maybe, is unlike some speculative tech stocks, the ones burning cash on dreams, SMCI doesn't really have that but what if narrative anymore, does it?
That's a great point.
It kind of matured already, delivered on that initial boom. So what makes it so vulnerable now?
It's vulnerable precisely because it delivered so well on a very specific and likely temporary demand surge. Now that surge is normalizing.
Right.
And the things that were its strength, speed, customization, become less unique when huge competitors jump in aggressively and the overall spending slows down.
And if you were to map out like a real-world sequence of events over the next year that could trigger that drop?
You could easily see it. Throw in a couple of bad quarters, right? An earnings miss that signals demand is definitely softer than expected. Maybe a bad headline, a data breach, an export problem hitting a big customer. And that positive momentum just dies. And in the world of these momentum stocks, once it's dead, it often stays dead for a long, long time.
So wrapping this up, let's be really clear. Supermicrocomputer isn't some kind of scam. It's a real business, real customers, real revenue.
Absolutely. If we connect this back to the bigger picture, though, it's also a company that got caught square in the middle of a perfect storm, AI hype, low float mania, that early mover excitement, and now it feels like the tide is going out. So this $100 thesis, it isn't really about predicting doom and gloom. It's more about normalization, reversion to the mean.
Yeah. Even great companies don't deserve those God-tier multiples forever, right? Could SMCI bounce? Sure, maybe. Could land new contracts reaccelerate somehow? Perhaps. But for now, the weight of the evidence, at least according to this analysis, suggests that gravity's winning. And that $100 mark, once just unthinkable now, looks like maybe the most obvious number on the board for you to think about.